Um, yeah, I've spent my entire career in pricing, 11, 12 years in the space because of these significant impacts that you can have on businesses. Teams spend all day long on sales enablement, training, marketing spend, with the goal of growing faster, but they neglect the easiest and most accessible way of growing their top line and bottom line, which is like your pricing model. So the company you described, we're really delighted to be working with. We doubled their win rate in one quarter, and that's how we led to that incremental $1.5 million of ARR. So the reason I spent my career to date and I've committed my life to pricing, my career to pricing, are because of these incredible outcomes that are possible. So wanted to spend a little bit of time. I think a lot of people who are struggling with pricing problems, whether it's like new product pricing, where do I go, or I have a package, I want to create new packages or bundles to sell, or I want to start winning more deals and not having to discount so much. Um, at its core, there's just a lack of understanding of how to think about pricing, how to think about monetization decisions in general. Like how should I even approach these types of questions in my business? So first thing I'd love to share, if we can pull up the presentation, is just a basic orientation on how to think about pricing. Let's kind of get on a firm foundation, and then we can start tackling specific questions. So if we go to the next slide. Um, and the next slide after that. Just to further terrify everyone on this call, for those who are fundraising, obviously venture markets have changed substantially, and not just for later stage companies, but companies of every stage. It's harder to raise today than it was a year ago. This is a headline I pulled from TechCrunch, but I think we all kind of viscerally feel this if you're in fundraising mode. Go to the next slide. And like I said, it's not a problem simply impacting enterprise. SMB mid-market feel it too. So when it comes to being able to successfully fundraise, this is what VCs look for. These are the golden metrics that determine whether you're going to get backed or not. Your ARR growth. Are you doubling every year? And that ARR growth is a combination of your win rate and your average sales price or average deal value. Is your net dollar retention at 130, 140% plus? Do you have a pricing model that is generating upsells and upgrades that are delivering these returns? How long does it take to break even with your customers? What's your payback period? That payback period is a combination of the lifetime value, the amount of money you're making per customer, less the cost of acquiring them, and then your gross margins. Are you acquiring customers, but they're not very profitable? So the good news, if you go to the next slide, is that all of those metrics are driven by your pricing model. Your ARR growth, as I just mentioned, is driven by how many deals are you winning and at what price. That's your pricing model. Your payback period is your lifetime value less the customer acquisition cost. The lifetime value of a customer is how much stuff you're selling them, which in turn is your win rate and your average sales price. Your gross margin is your average sales price less variable cost. Again, your pricing model is driving your average sales price. And then net dollar retention is all about the tiers, the packages that you have to sell, the number of packages, what are you including in each package, what unit are you charging people, is it a per seat, is it a per send, is it some other price metric, your pricing model. The thing that everyone is neglecting and has a way of managing is driving all of these things that VCs care about. And this thing is the thing that's within your control and is your secret weapon if you are aware of this potential in your business. So if you go to the next slide. So how do you optimize your prices? What is the thing that you need to think about? If you remember back to your economics days, I'm an economics kid and went to grad school for econ as well. This idea of elasticity, if you remember that demand curve, this chart here, and you have the quantity on one axis, you have price on the other axis. Measuring the price sensitivity of your customers is how you do all the things that we just described. The reason why people struggle with pricing decisions is fundamentally they don't know what the price sensitivity of their products, of their offerings are. They don't know the price sensitivity of the based on a new package or bundle they're offering. They don't know the price sensitivity of a new product they're about to launch. They don't know the usage. As you graduate with a tool and you're going up in consumption, they don't know how to set the tiers. It's fundamentally this challenge and this question back to your economics days of measuring and capturing price sensitivity. So that's the overall orientation that I encourage teams to think about. I'm sure there's some questions here on the back of that. I'll toss it to you.
Okay, great. Well, let's just dive in and say, what's your best advice for pricing a new product, Greenfield?
Yeah. So with a new product, it's the same process that you would figure out how to price an existing product, which is you need to measure the price elasticity, price sensitivity of the thing that you're selling. So tactically, what does that mean? Well, you look at data, and for new products, you by definition don't have any historical data to look at. You can't pull a report out of Salesforce and measure. You have a few different options. One is that you need to start with really all of the things we're talking about. The core tool at your disposal is price experimentation. You need to go to market and you need to present offers to your prospects and capture their feedback, both in terms of the quantitative feedback, do they actually buy stuff and at what price, but also qualitative, and hear from them their reaction and their perception around prices. A lot of people are afraid to do that step because it involves risk. So if you're looking for a simpler initial thing to do, if you really have no idea how to set new product prices and you have no data, pricing interviews and pricing surveys are your best bet. So what are those things? So there are within pricing pretty standard off-the-shelf studies that you can launch. Conjoint, Van Westendorp. If you reach out to me, I can point you in a specific direction. But you can send out surveys, studies into your market, and gauge their perceptions of price. The limitation with surveys or interviews, it's the same thing except you're talking to someone, is you're asking people a hypothetical question about a decision that they have no skin in the game around. So you're asking someone, how much would you pay for this? It gets you some data, and that's better than nothing. And again, if you're in a position where you have literally no idea where to set initial prices, it gets you going. But the de facto answer is experimentation. When you actually present someone with an offer, do they bite or do they not? That's
Got
going
it.
to tell you
Okay.
a lot.
Yeah, yeah. Well, sometimes we talk about there's reference pricing, like what do they pay for a competitor? There's simple cost plus, right, which is what could you possibly sell it for to cover your costs, which isn't a great one, and then value pricing, like what are you delivering to them in terms of value. So those can be, helpful, I think, as well. I wonder if we should move right to the framework for doing the research in terms
Yeah.
of if you have a product. So maybe we'll bring up those slides and then they'll use that framework.
Yeah, let's do it. So if we switch over to, great. So as I just mentioned, the gold standard in doing pricing research is experimentation. And a lot of, like, how do you run an experiment? And particularly teams struggle because they think, well, I don't have a lot of data. Doesn't experimentation only work if you're an Uber or a Lyft or something like that? And the answer is absolutely not. You need to run experiments. So let's step through how to do it. So the first thing you want to do is develop your hypotheses. Really, this whole workflow is just implementing the scientific method. That is the trick or the hack to developing high growth pricing. So what initial hypotheses you have around pricing, capture those, and specifically you need to measure what is the target I'm after. A lot of teams say, like, I want to win more deals. What is the win percentage that you're after? Or I want to increase upsells. What is the target metric like the number of upsells or the number of conversions that you're after? You need to actually have a number that you're optimizing towards, not have this amorphous, loosey-goosey goal. So you have that metric, you generate hypotheses, and those hypotheses can come from the things that you mentioned. So you can imagine, if I were my customer, what would be the next best alternative to the thing that you're offering? And that's a competitive analysis, et cetera, et cetera. You could interview customers, as I mentioned, survey customers, as I mentioned, to generate some initial ideas. And then you want to start kind of pruning the higher, you want to look at the hypotheses that you're generating that have the most data behind them, or the higher probability bets. So you leave this step with 2 or 3 core hypotheses that have the most data, the most support behind them. And you march towards the second step. If you go to the next slide, which is actually running the experiment. So when you run the experiments, you are presenting offers to your market. You are pitching people. When you actually ask someone for money, it's a totally different thing than running a study, or using something like, I see in the chat, conjointly. People have now risk that they have to incur, and you're making them make a decision. That's going to tell you them. That's going to, at Accrue, what we do is this whole workflow in an automated fashion. But if you're doing this on a one-to-one basis, this is going to get you the highest quality data. And the way positioning here matters. And what I mean by that is, if you position yourself as a certain category, your customers are going to benchmark you against everything else in that category. There's a great book by April Dunford, Obviously Awesome, which I encourage. It's not a pricing book, but it's a positioning book, because it changes the valuation you're going to get from someone. It changes their willingness to pay. So how you position and sell your product makes a huge impact on price sensitivity and price elasticity. Then if you go to the next slide, you're in market, you're making offers, pitching people. You need to capture that data, both the quantitative, which you'll know, am I winning deals, and at what price did I present, but also the qualitative. When you present an offer and someone says yes or no, the immediate question you want to ask is why. What are they comparing you to? What willingness to pay and price elasticity aren't these like numbers that people like walk around with. It's all relative. They're all when you come up with a number and you're willing to pay for something, your willingness to pay is benchmarked off of all the other things that you think are like that thing. So as you are making offers to people, you need to understand the reference prices that they're using in order to arrive at their decision of whether they buy from you or not. Confounders here matter. So as you're running experiments and you present offers to different types of people, confounders here are, what are the variables that might explain why someone said yes and someone said no. So an example is, one person might be just a larger customer. They might have much more revenue than the other person. That explains that's a big impact on their willingness to pay. Maybe the two people are in two completely different verticals. One person's in biotech and the other person is in fintech. That probably changes their willingness to pay. So, again, at Accrue, we're doing all this in an automated fashion and controlling for confounders. But if you're doing this on a one-to-one basis, you need to ask yourself the causal inference. Why did one person say yes and the other person say no? And if you head to the next slide, the last step in the process is to revisit, to look at the data you've been collecting and say, what have I learned about the price sensitivity of my market? And the bit here, the reason why this is science, pricing science, and this is the scientific method, is you're trying to find cause and effect. Because if you're winning deals at a certain price and you have no idea why you're winning those deals, you're not going to be able to repeat it into the future. And you're not going to know why your pricing model is the most effective one. So as you look at your data, both the qualitative and quantitative, you're trying to figure out cause and effect. You're trying to measure that back to that demand curve. Where on that line am I optimizing my prices? And that data, that process is going to generate new hypotheses for you. So you're going to learn some new things and iterate on your hypotheses. This is something at minimum you need to do quarterly, of sitting down and looking at your prices. Some teams never have most teams don't have a regular cadence of looking at their pricing, making sure it continues to be optimized. And it leads them to all the problems that we described before. But this loop of hypothesis generation, experimentation, gathering data, iterating on those hypotheses, that loop is a forever thing. Because your pricing is how you're getting paid. Like you don't want a model that you just set it and forget it. You want this thing that is a cash cow for you, that is continuously returning huge returns to your business. So that is how you do measure price sensitivity, price elasticity is the workflow I just mentioned. That was a lot. Hopefully that's helpful.
Yeah, for companies that aren't yet using Accrue, is there a tech stack that people should be using, or is it about using Salesforce or their CRM and regrouping quarterly or whatever?
Yeah, I mean, if you want to do this on your own, you need to. I guess it's going to be a lot of work, but you build reports in Salesforce. The kind of data you need are your historical opportunities. You need data on your accounts, the customers, not just who they are, but all of the variables that you think might explain their willingness to pay. So industry, revenue, channel, etc. Um, and then you can start to cluster your customers. You can probably do this in Excel. I'm not. It'd be tough, but you could start to cluster your customers. So you look backwards and you say, uh, what groups of my customers are paying me what range of prices? So you can say maybe my large healthcare companies tend to give me this range of prices. Here's all the close won and close lost deals. And this other cluster of my customers, these are the historical prices that I can observe. So you can measure price sensitivity by proxy by looking backwards and measuring historical prices that customers have paid you. Um, and then use that to inform hypotheses and the things that you ought to do moving forward. It's the same thing with usage-based pricing. I get that question a lot of how should I set up my tiers? Well, the first great place to start is to pull your historical usage data to see what types of products people have purchased and are using, and use that, do the clustering analysis, and use that to inform the sets of the tiers and packages moving forward. So that would be my
Yeah.
recommendation if teams want to.
And how should founders think about usage based versus tier based pricing or seat based pricing or others? How do you advise people to start? Because the biggest problem with usage based pricing is it may deter usage.
For sure, for sure. So, I mean, lot to be said here. I mean, I think the core idea is, what is the metric that you're optimizing for? So in this case, it would likely be upsells, net dollar retention. So first basic question is, are you at the net dollar retention that you want? And most teams have no idea what the net dollar retention is, which is the sign of a healthy usage based model. You should see growing net dollar retention. And when a VC is doing due diligence on you, they pull your financials, throw it in their model, and they calculate net dollar retention of your business. So that is the gold standard in terms of whether your usage based model is working or not. Is are the same customers buying more stuff from you a year later? There's a quantitative element here of how you measure the health and success of your model. The qualitative side is people. The metrics that work are accepted by your market. So a lot of teams get into trouble because they come up with these really exotic pricing models that have like 14 different variables because they think it's more fair, but it completely confuses customers and therefore throttles adoption. So the best models, people perceive it as, I'm paying for what I get. This is aligned to the value that I'm receiving, and I can have some sense of predictability. I know what I'm going to spend on this a year from now. So those are the qualitative things.
Okay, got it. That's excellent. And it does seem like the easiest way to sell and price is to deliver overwhelming value and then capture a portion of that. Can you talk at all to how to get data back from customers so that you, as the seller, can understand the ROI of what you're selling?
Yeah, I mean, as a numbers guy, I'm always obsessed with quantifying, statements like that. I mean, ultimately, the measure of, are people getting the value from your platform that you deliver, is measured in your contract value and your average sales price. Is that average sales price and win rate going up consistently over time? Or at renewal, are you seeing a lot of churn? Are you seeing sales cycles longer because people are negotiating price? When price becomes a point of negotiation, that means that people do not believe the value that you're presenting. So I actually can see it in the numbers. I can see people's perceived value, and the value that they ascribe to whatever you're selling in the data itself. I look at renewals, I look at upsells, I look
Yeah.
at ASP, etc. Those all should be climbing over time.
Got it. I was just wondering, there are cases, right, where customers will share data back, like, or you have an integration with a system that they use, so you know they're selling more, or their conversion's going up, or their costs are coming down, right? So that could, we don't have to dwell on it, but I think it's then hopefully you can sell something that is economically rational as well as emotionally, hopefully, good business.
Yeah, I used to think. That's certainly an excellent point. I mean, there's a whole field of economic value analysis where you try to quantify the financial impact that you're having. So, to your point, you're selling marketing software, and you're like, oh, our tool helped you uptick your opt-ins by 5%, and that blah 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 blah. But in reality, value is subjective. Every decision is based on someone feeling like your thing is worth their money. As much as we'd like to quantify in economics, there's the utils. Could we quantify value with people? Can we measure that there are 5 utils here and 15 utils there? It's like, actually, no. All value is subjective. All value is really in the eye of the beholder. That there's ultimately the only way of measuring value is the price someone's willing to pay for your stuff.
Yeah. Yeah, well, it's an interesting dance because I do think that knowing your seller, some people are emotional buyers, some are rational buyers, but in recessionary times, especially services that pay for themselves, services that drive revenue and reduce cost tend to be, renewed. And I want to just switch gears a little bit. We have one question in the chat from Wynn Brown. Thank you, Wynn. She says we have 2 products. One's clearly underpriced, and they've gotten clear market feedback on that. The other, they're not sure if they can raise price. How can they test if they can raise prices?
So one is clear. So first, how do you know that it's underpriced is my immediate first question to the first product. The other, how much we can raise price. I mean, easiest way is just to raise prices and go see what happens is the short answer to that question. You can do some of the things that I've described before if that feeling that terrifies you. If you Google Van Westendorp, it's a type of survey and or interview you can do. It's pricing best practices. From a research standpoint, so you can talk to people and ask them the maximum willingness to pay that they have for that second product, and you can get the range of prices. But again, the big caveat there is you're asking people a hypothetical question. I mean, what people say that they'll do in a survey or a study and what they actually do when you present them an offer can be 2 very different things. So it's scary to price a new product because you want to win deals. You want your product to be adopted and for the world to use it. But ultimately, even if you go through the route of interviewing and surveying, you're going to have to make an offer to someone at some point. So my belief is just cut out that first part and just go make offers and measure what happens. Would be my off-the-cuff answer, but without any further context on the question.
Okay, great. So why don't I'm just trying to think. Maybe we should just go into your next framework, and you talked a little bit about how do you know if an experiment worked?
Yeah. So if you've structured an experiment well, you know up front what the target metric is that you're trying to improve, and even that first step can be really challenging for people because they know something's wrong with their pricing, but they don't know what success looks like. How would you know if your prices are the right ones or optimized? And it comes down to the metric in advance that you've decided you're trying to impact. So
okay. Got it.
options are like your average sales price, win rate, your net dollar retention, your payback period, your gross margin. It's probably one of those 5 things.
Yep.
So if you're below where you need to be and you think pricing is, impacting it, then success is, am I moving the mark? Yeah.
Got it. And given that we're, seems like we're heading into a much tighter market, and we hear from portfolio companies that pipelines are, taking longer to close and things like that. Are there good questions that you can ask customers to pre-qualify them in the sales and pricing process?
Yeah, for sure. So we incorporate it within our sales process is to actually name the alternatives in your pitch deck. So you've gone through discovery, you've uncovered a problem that someone has, and you've gone through BANT or whatever MedPick, and you're at the point where you're presenting them a price. The big reason why sales cycles take longer than they need to is the negotiation period, back and forth on price. So if in your proposal, when you present price, then you say, okay, so you describe XYZ problem to me. If you wanted to solve that problem today, these are the options available to you, and to actually have it on the slide. And here's what those options cost, and to confirm it with prospect. Is there anything? Are these what you're seeing too in terms of prices? And is there anything else that you would pursue? Like, are there any other options that you would explore other than the ones on this slide? You have competitor A, you have option B, da da da. And if they say no, that's pretty much it, and those are basically my options, then if you've done a good job uncovering the problem and you've mapped out the alternatives, then you can say, listen, of all of your options, here's why we are the best bet. And it's not just because we're cheaper. That is a tendency, especially with early stage teams, just to discount to win deals.
Right.
But given your options, the price to value ratio is the jargon here, but we are your best option for the reasons you mentioned and the alternatives available to you. So if you allow them that, because they're doing that already, if you allow them to go do that benchmarking and comparison on their own, they're never going to come back to you. You need to have an explicit conversation
Correct.
up front with what the options are, what they cost, what you cost, and to make sure that you're
That's great advice.
yeah, is best option.
Great. Okay. Well, Chris from London, Chris Preep says we started with a very low price and need to walk up existing customers, and they've identified customers who have very high adoption. So how can they approach price increases, and how much pressure should they apply?
Um, yeah, I mean, it depends on the size of the price increase. Um, and it sounds like there's some segmentation in that second sentence, and some segmentation work that Chris is doing, which is really great. Um, it's I would treat first off, one of the easiest things to do is to set an automatic price increase on your contracts, and that's, you can call different things an escalator, but upfront to say, at the end of this year, if you continue using us, there's going to be a 5% price increase. To be upfront about as you adopt our tool at renewal, you are going to commensurate with the R&D we put into our product, the cost we put into our product, the continued enhancements, we build in an
Yep.
auto escalator. So if you preemptively have that conversation at the top of the contract, you're getting ahead of it at contract renewal. As well as, during the renewal process, treat it like a sale. So go through the same thing. Here are your options today. Here's where if you continue having this issue, here's where you would go elsewhere. Our price is going up. Does that still work with you, given the alternatives that you have available to you? So I treat it like a sale, because it is. You're selling someone on
Yeah.
a higher price.
It's interesting because Andreessen did some pricing work, and they said startups generally, or often, B2B startups often underprice because they feel like I just need to get the deal, which may or may not be good, because they also said that you shouldn't worry too much about your very early customers having legacy pricing, because you don't want to churn slash annoy them by jacking up prices too much. So some businesses literally make that decision, right, to not mess with anchor customers that much, and they say, okay, we'll recover it over time, because they want them to be evangelists and to be happy and renewing and all that kind of stuff. That being said, I think you hit on a really important point, which is what's different, because the problem with startups is often you don't want to grow your pricing 5%. You want to grow it like significantly, but your product is so much more reliable, feature rich, benefit oriented by the time the renewals run around. So I think that is interesting.
Yeah, with
In
SaaS
some,
as
yeah,
well. Oh, sorry.
no,
Uh,
no,
what I was going to say, the interesting thing about SaaS, most products, um, time to value, like you get the most value for something upfront, and then diminishing returns after that. So, like, stupid example, but you eat a sandwich and you immediately experience the value, and then, like, it's done. SaaS and workflow products are the opposite. The value you experience is the smallest at the very beginning, and it only grows over time. So if a product is a soft, particularly SaaS, is adopted, it becomes part of your work. Take Slack as an example. For most of us who were, previously used other systems or didn't use the Slack at all, there's a period you're getting used to Slack and how do I enter channels. And now, for most of us, it's an indispensable part of our stack. Your price, your willingness to pay is a lot higher now than it was a year ago, 5 years ago. Take Zoom, any of these products. So it's ludicrous to me that teams don't ever consider price increases, don't ever consider changing their prices when the sensitivity of their the willingness to pay
Yep.
for their product is actually a lot higher a year later, 2 years later than it was when a customer first signed up.
Right.
Which is why
and getting those,
which is why regularly optimizing your prices, reviewing your prices, why there's in aggregate billions with a B billions of dollars that teams miss because they don't have a good beat on the price sensitivity of their customers. They don't have it's just a set it and forget it, create prices, and then in a spreadsheet somewhere, then.
Yep. And to your point, getting the data points to inform sales that are both emotional, evocative, and rational. So we saved you money here, but here's some usage metrics. Here's some case studies. Here's some, feedback from your people in your company or your customers of using the product. I think that's really important. Okay, let's ask another one. How do you balance pricing to win the deal and break into the market, and versus what your product is worth? Any quick tips on that one?
Yeah, well, I don't know if it's so if you go back to that demand curve, what you're saying is, so in this context, replace quantity with win rate on one axis and price on the other. Yep. You want the price on that curve that is maximizing your price but still winning the most number of deals. That is price sensitivity. That is the definition. That question is what I've spent 12 years trying to answer. But in short, it's once you know the minimum and maximum price, and there is a minimum, but the minimum and maximum price that any prospect is willing to pay, that's what a product does. Subtle pitch. But once you understand that range of acceptable prices, then you know where to price to both win the deal and maximize your revenue. Absent knowing that range of acceptable prices, you're right. You'd have no idea what price wins the deal and still, gets you the price and contract value that you need.
Okay. And then let's go to fintechs. How do you tailor this framework to fintechs that combine software and credit products? Or we also have some portfolio companies that are software and marketplaces. But let's stay on fintech. So in other words, fintechs that inherently take some level of risk in the products they fulfill for a customer.
Yeah, it's an interesting question. There's a whole underwriting and credit. The whole, I guess, the whole space. But there's fundamentally nothing different about fintech versus other products. The reliance on underwriters and creditworthiness is certainly a complicating factor, but it's the same process. You've got to figure out what your stuff is worth to people.
Right, what it's worth or what it is relative to competitors. Because in some of these cases, they couldn't access credit or they couldn't get it in this time frame or something like that. So I guess it's just figuring out how do you put a quantification of value and then communicate that compellingly.
For sure. So within to take this within finance, there's this idea, efficient market hypothesis, that the price of a security represents all the available information in the market about that security, that the price, everything's priced in, all the information is priced in. That's the exact same thing in every other context, that you actually don't really need to go look at competitors. All the information you need is directly found implicitly in the price sensitivity of your prospects. They are incorporating all the information about the world, your competitors, their other options, their own hierarchy of values, what's important to them, their decision criteria. That all happens rapidly in their head. It's just, we're all walking around with our own little price sensitivity calculators. So if I can capture that number, that range of numbers that each person walks around with, that gives me all the information it's all baked into that number. So whether it's fintech, it doesn't, I mean, there might be certain things that
Yeah.
make experimentation challenging from one vertical to another, and there's some important nuances. But fundamentally, it's the same thing. You got to go make offers and see what people are willing to give you.
But it is interesting, though, that what you said about we're all walking around with our own price value calculators. I feel like one of the jobs of sales is to put a new mental model, plant the seed, right? And maybe saying something like, here's how another customer in your vertical thought about the value. And um, just giving them the comfort, right, that to adjust or adopt a new model. I don't know. This is interesting.
For sure. So like take something like your cup of coffee that you buy in the morning. If you don't sit there and like have a budget for how much you're willing to spend on coffee, like a single cup of coffee. You walk into a coffee shop and there's a barometer internally. You go, if that cup of coffee was $20, you'd be like, the hell? Why is this coffee so expensive? If that cup of coffee was a nickel, you'd go, what's wrong with this cup of coffee? Why is it so cheap? And so, like if it's between, I don't know, I mean, San Francisco, so $20 probably is the right price. But if it's between, I don't know, $4 and $6 is
Yeah,
a range,
yeah.
you don't even think about it. You're just like, okay, yeah, seems reasonable. You don't sit there and go,
Right. But the
oh,
tricky part is so many of our products are new. And then the question is, do I need them or do you need them instead of, something else? Yeah.
yeah, for sure. I mean, but it's the same. What that mental exercise I just walked through is what prospects are doing. They're like, I have this barometer, this range of acceptable prices. The price that would seem expensive, a price that would seem too cheap,
Right.
and it all happens rapidly when you present a price. They go through this calculation. So
Yep.
the trick here is to figure out using data what that is for every one of your customers. And if you have that data, that range of acceptable prices, then boom, I know what price I need to drop this down to if I want to just accelerate deal adoption, speed up
Got
deal
it.
velocity.
Yeah.
I know the upper range if I want to just dial in top line growth and ARR growth. It's like magic. That's where all these incredible returns that I've described come from, is having that data at your fingertips.
Right. So if it's not value based or ROI driven pricing, it's reference pricing, and picking the right benchmarks could be helpful because they could be competitors or alternatives, but it could also be other things the business buys, right? Like if the business buys Oracle licenses or something like that, you might put yourself in that category versus if they license a much cheaper, piece of software. Um,
For sure. Yeah. I mean,
okay.
yeah. Positioning.
Okay, let's and John had a question. How do you which we touched a little bit on, but it's a huge hot topic. So how do you decide whether it's a site license, a SaaS product, versus seat or per use licensing? It feels natural to allow companies to increment their usage, but also simplify with a site license. So, just walk us through that decision.
Yeah. So this is what John is describing is a question of the price metric or value metric. It comes with different comes under different labels, but what is the unit in which I'm going to charge people? And the answer is I don't know in the abstract, and nor will you, John. The question is if you make an offer, a site license or a per seat. So first, do you have data on either historical data on either of those pricing models? And if the answer is no, then the only way you're going to be able to decide which one of those works is what is the metric that you're after? Are you trying to maximize for win rate, upsells, average contract size, whatever? Go in market, present both versions of this offer to prospects, or maybe present one offer for a quarter and then the second offer in the next quarter. And you have a right to do that. This is your business. You can set whatever prices you want. And then you measure what happens to that first cohort of customers. How many deals did you win? Whatever the metric is that you're optimizing for, did I increment towards that? Am I moving in that direction or not? And then let's say the second quarter, you try the second version, and then you see what happens. There's no way to get. I think people lean on consultants because they think consultants have this like magic answer for them, when really they have no idea. And most teams just want a smart person to come in and tell them, yep, whatever decision you're about to make is the right decision. Now give me 500K. In
Yep.
reality, you know what you need to do. You need to go test out. It's scary, I know, but you need to go test out versions of your offer and see what your market, what your prospects are willing to pay you, and what impact that has on whatever metric that you're trying to solve for.
Yeah. I mean, it's an interesting thing. In the beginning, do you care? Like in the first couple sales calls, if you said it's X per user, or I can give you a site license for Y, the most in the very early days, it's probably just better to get them using it. And then it seems like many people either it just depends. Maybe it's all reference based on what that buyer is used to buying. If they're used to buying per seat licenses, then it's probably more comfortable. I don't know. It's just an interesting
Yeah, I
question.
mean, the freemium, it sounds like the freemium model, I think founders just adopt it because all the cool kids do freemium, so then they adopt it themselves. But yeah, I mean, that obviously has merit. People, when you de-risk a product by giving them a trial, a pilot
Well, or
period.
even per seat pricing, right? Versus some tier, you know what I mean?
Sure,
Like
yeah.
in one sense, you're indifferent, right? If it's per seat or whatever. So I guess it's whatever gets it done, and maybe just in trial and market. Let's talk about a question we got earlier, which is for SaaS products that have a learning curve and value is a function of data uploaded by the user. Have you seen anything to help companies help see their customers see time to value sooner? Um, in terms of maybe they bring someone in for something a small price and then they're trying to encourage usage. Any tips for that?
Yeah, I mean, I think the POC or pilot route, a paid POC or paid pilot route, is the easiest way to get to shrink time to value. Instead of uh, instead of signing someone up and then hoping that in a quarter or 2 quarters they're going to fall in love with your tool and it'll be sticky and yada yada yada, running a pilot and showing them upfront what problem you're going to be able to solve for them. And you have to get creative on based on what you're selling, what that pilot would look like. It could be analysis that you provide. It could be walking through a specific user, getting a user, like hand holding a specific user and getting them to their first win, first victory. You got to charge for it. That person has to see enough value in the pilot, and you got to know that they have skin in the game. But that pilot, that trial up front, shows them evidence that this thing is valuable to them, and that then the subscription becomes, or whatever the upsell
Yep.
becomes, is a lot less risky for that person. So definitely
And then
encourage that.
um, some people have the option to charge non-recurring engineering fees or setup fees in addition to say a usage fee or a SaaS fee. How do you deal with that?
Oh, I think a huge mistake I see teams do is waive or heavily discount implementation because they're like, we don't care about non-recurring revenue. What we care about is the subscription. So, but the problem with that is you are disincentivizing people to be engaged in the onboarding process. If they have no money that they have to give up front to be committed, your sales cycle length, the onboarding, the time to value, all that stuff goes way up. If there's something magical that happens when people give you money, like before someone's actually wired money over to your account, paid whatever, they are still they don't have skin in the game yet.
Right.
And so, what the amount that you charge, sure, we can optimize that price, the non-recurring fee. And I get it, the subscription revenue is the thing that's most important in the business. But you got to get customers that are engaged, that are along for the process. And if they're not willing to give you a little bit of money up front to demonstrate their commitment, they're not going to be. I just think
Got it.
they're not
Yep.
going to be a great customer for you long term.
Got it. And Laura Crabtree asked, she's been told not to name competitors. And first of all, I like that strikes me as odd. But when you talk about other options, should you dance around competitive names? What do you think?
No, name them. I mean, your customers are going to.
Right, right.
Why?
It seems, yeah.
I mean, it's a scary decision for a prospect. You know, when you ask people for money, it's scary. Like they don't
Yep.
know you, they don't trust you. Like you know potentially never worked with this person before, so they're going through the decision process on their own. They're going to go look up competitors. They're going to look at reviews. They're going to talk to people.
Yep.
You know, depending on the size of the purchase. I mean, the amount of diligence that they're going to do. So instead of hoping that they on their own come up with that, oh, your solution is the best solution, like magically on their own, you got to make it explicit and have a direct, honest, sincere conversation. Here are the options: competitor one, competitor two, or do nothing and do this in house. Are there any other options that you think that you would pursue or could pursue to solve this problem? And you might be surprised. You might hear about new things that people are considering or whatever, and then you incorporate that into, you know, for future iterations. But not only the name of the competitor's price, and it could be a range. You could say competitor one probably is going to charge you, like for us, we get benchmarked to consultants all the time. And we're like, cool, if you have this problem, this pricing problem, and you try to do this on your own, you go to a consultant, consultant's probably going to charge you, you know, for a growth stage company, 250K to $1 million for a one-time project. You're like, yeah, that's probably, you could try to do this in-house. You could have a sales ops person or your chief of staff, I guess, do this. That comes with a cost. Or use us. So I'm naming competitors, naming prices, because that's what your prospects are doing, and it's on you to help guide them to the right decision.
Wonderful. Well, Emmanuel, thank you so much. And you know, really, you have really created a platform that puts the science into a usable format. So, and thank you for sharing insights today. And people can reach you on LinkedIn. Is that right? Okay, good.
People can reach me on LinkedIn. I'm sure we can drop my LinkedIn URL in the chat.
Yeah, yeah. And then, and usually the companies that work with you are late seed or Series A or beyond. Is that right?
That's right. Yeah, late seed, Series A, Series B. If folks have heard all this and it's like this all makes sense, but this sounds hard, or I don't know how to do any of that, and you're in that kind of growth stage space, feel free to reach out. If we can help you, we certainly will. If we can't, we'll point you in best direction that we can.
Great, great. Because we certainly have some portfolio companies prior to our investment in Accrue that have commissioned these large $250,000, $500,000, you know, pricing studies with BCG. I'm naming them, and I would say the results are mixed. So it seems like there's so much opportunity for us to all get smarter on pricing. So Emmanuel.